Chair recognizes the gentleman from Tennessee, Mr. Fincher, for 5 minutes.
Thank you, Mr. Chairman. Let me be clear, too. Thank my colleagues on the other side of the aisle for some good questions. This is an attempt to move forward on a bipartisan approach. Mr. Carney and I have had the conversation, not putting the blame on any one person or party, but in order to move the country forward and in order to stay with the focus of job creation. You know, I've said many times, I don't know what was happening here before I got here, but I know what's happening now. So we're just looking at moving forward. I want to take a couple of points. Mr. LeBlanc, you made a few minutes ago the statement of dialing back the $1 billion to $500 million. Do the other panelists agree with that, Mr. Brannock?
I mean, I think it holds merit to do an analysis, and absent the data, which of exactly how many companies would fall into each of those categories, I think it would be difficult to comment on.
The IPO task force, when in its recommendations, actually supported the $1 billion cutoff for the reasons that we talked about. Institutional investors that were participating in our committee looked at that. Because of the time it takes to prepare and the growth, you have to actually start, you know, you have to aim, you know, for a couple of years. And because these companies are still investing in their growth, it is a large percentage of their bottom line. So we are supportive of the $1 billion revenue and the $700 million public float definition.
Mr. Stafford.
And I would agree with Ms. Mitchell. I support the $1 billion. I think, as I understood Mr. LeBlanc's testimony, the litmus test of a net profit margin is far different than the companies I see where they're rapidly investing in operating expenses. So on a net margin basis, that's a far different metric than gross revenues. Okay.
Mr. Brannock, just again a common sense question here. How soon after a company files with the SEC to go public will it take for them to actually enter the marketplace and issue shares for the sale to the public?
Right. Well, in a good economy, about a minimum 3 months. But given the volatility in just in this year alone, you know, it's taken companies significantly longer than that. So 8, 10 months, 12 months, and then there are even some companies that are on file now that filed their S1 a year and a half ago.
Mr. LeBlanc.
One comment, I'd question though, that's from the date you file. There is a tremendous amount of time that occurs before the date you file to prepare for the filing, which could be 6 months to a year, to put all the information you need together financially to prepare the application.
Absolutely, and to that point, and I apologize if I didn't misunderstand the question, but we advocate that a company should begin acting like a public company 2 full years before they actually file their S1.
Okay. Ms. Mitchell, when a company is unable to go public, why are job losses so heavy when the company is sold or merges with another company?
It's an important fact, and you see it. You know, we've talked about the longer-term study showing that 92% of a company's growth occurs post-IPO. The study that we did with NASDAQ this summer actually looked at newer companies, because we wanted fresh data around the cost of going public, including Sarbanes-Oxley as an example. It's interesting, one of the questions we asked in that was job growth. These were companies that had gone public since 2006. So let's say the average age is somewhere in the 3-year range, roughly. Their statistics were that 86% job growth had occurred post-IPO, which tells you that most of that job growth occurs early in that company's IPO cycle. So number one, that's why you want to go public. When a company sells itself, I mean, as one of my colleagues always said, what would Seattle look like without Microsoft? What would, you know, Silicon Valley look like without Intel? You know, when you become a division of a company, first of all, when you get acquired, all the redundant positions, the CFO, the CEO, a lot of the management team gets laid off. And you may not have the opportunity to grow and become an independent company like you could have if you had been able to stand on your own and go public. And it's interesting to see with all these M&As, and it used to be 90% of venture-backed companies went public. Now 90% sell themselves. One of the impacts of that, the number of tech listings has gone down, the number of acquirers has gone down. So there's even less competition. If you decide to sell yourself, there are even fewer companies to sell to. We need to get more companies public that are big, that not only can themselves create jobs, but even acquire some of the smaller companies. It's really a shrinking pie. And again, it's moving overseas.
Right.
Well, thank you, guys. So one last comment before I yield back. Making sure the investors are protected is critical. It is. But also making sure that the environment is friendly for the creation of these companies will also give the investors an opportunity to invest. And you can't have one without the other. And so no one here is wanting to, the pendulum sometimes here swings way too far either direction. But we're trying to take a common sense approach. Again, I thank Mr. Carney and my other colleagues. But with that, I yield back. Thank you, Mr. Chair.
Gentleman yields back. The chair recognizes